Welcome back to Upticks with Jake and Cory. I'm your host, Jake Falcon, the founder and CEO of Falcon Wealth Advisors. And I'm joined by my co-founder and co-host, Cory Bittner. Cory, welcome back to the show.
Jake, I'm excited to be back in the studio.
That's right. So this is episode 2 of the studio, but this is episode 370 of Upticks. So for our loyal listeners out there, Cory, if you want to check it out, we've got out there on YouTube, Apple, iTunes, and Spotify. We've got over 300 episodes of content, all geared towards enhancing your financial literacy. And today, Cory, we're actually going to talk about a topic from a loyal listener.
Yes.
To talk about charitable donation changes for 2026. Because as part of the One Big Beautiful Bill Act, they actually changed the way that certain donations are going to be deductible for your taxes. So I think it's a very powerful and timely topic. And thank you to the listener who brought this up.
Yes.
Effort of disclosure, though, before you do any official tax advice, go check it out with your CPA or your tax accountant. We do tax planning at Falcon Wealth Advisors, but we are not CPAs, so you want to just double check everything by your tax advisor. But today's show, again, we're going to go over some best practices as we approach the changes for 2026. Sound good, Cory?
Sounds good.
So starting January 1st, 2026, several key changes are taking place, Cory. And the one that actually bothers me the most is this new 0.5% AGI floor. Do you want to explain this for our audience?
Yes. So charitable deductions only apply to amounts that are exceeding 0.5% of your adjusted gross income. So an example here is that if your adjusted gross income is $200,000, the first $1,000 or 0.5% won't count.
Yeah, which I don't understand why they did this. And these are only for people that itemize.
Correct. Yes.
So if you're
good point.
so if you're itemizing your taxes and you make $200,000 a year, and let's say you give $2,000 a year away,
Yep.
well, you're only going to be able to deduct half of that now.
Yes.
Which that's why it bothers me.
Yeah, I mean it's charitable giving
Right, you're like penalizing the high income earners
that are
giving.
giving intentionally. Yes.
Yeah, so I'm not a fan of this. Also, as part of this kind of structure, aren't they capping it at 35% of your tax bracket? So if you're in the 37% tax bracket, you don't get to deduct the full 37% even. It's capped at 35, right?
Correct.
Am I right
Yeah,
on that?
down from 37. That's right.
Yeah, so I'm not a fan of that either. So people in the highest bracket already are paying the most in taxes. Now they're getting to deduct not according to their tax bracket, but according to a capped one. And so for people out there that think the One Big Beautiful Bill only benefited the wealthy, this is a prime example that it didn't do that. In fact, from my analysis of the bill, Cory, is I think it kind of just benefited people in the middle and not a lot. Would you agree with that? I didn't think it helped low-income people very much, and I don't think it helped high income. I think it helped, which is good. Maybe most people do fall in the middle, but maybe that was the point. I don't know.
Yeah, I think that's where most people fall, and I think that you're right. There's not a lot that helps. I mean, I think there's a lot that helps corporations, probably more than anything, maybe even more than the middle class.
Yeah. So anyway, so we're going to go over some tips, right? So again, the show is not advice, but we're going to go over some strategies to help with this new 0.5% floor. But there's also another thing changing, Cory. Talk about the universal deduction for our non-itemizers.
Yes. So if you're taking the standard deduction when you file your tax return, which is a huge majority of the people in the United States,
True.
Take the standard deduction. If you do take that, single standard deduction filers can claim $1,000 if they're single or $2,000 if they're married for cash gifts to qualified charities.
Which I think this one's great, actually, because
Yes.
a lot of people that don't itemize haven't been able to deduct anything.
Correct.
So this is one good thing that's out of it. So if you don't itemize, the key here for 2026, and if you're gifting to charities, you're going to want to make sure that you start noting it or logging it and
Yes.
filing it, and you let your tax accountant know this so that you can get that $1,000 if you're single and $2,000 if you're filing jointly deduction, which is a good thing. This is a good thing, part of it.
I think like you just stated, maybe to say it another way, for people that have taken the standard deduction and are going to continue taking it, maybe people aren't keeping track of what their
Right.
charitable giving is. So at the very least, make sure you're taking advantage of the new introduction of the $1,000 or $2,000 amount that can be deducted,
Right.
even if you're not itemizing.
Right. And again, this is for 2026, so you don't have to worry
Correct.
about it for this
Next
year.
year.
Then there's another one on here for the corporate giving, Cory. Corporations must exceed 1% of taxable income to deduct gifts. and it's still capped at 10%. I don't know how that impacts because I don't really deal with corporate giving as much.
I'm not really sure either.
Yeah, but that's just part of the change too. The carry forward rules remain the same, so nothing's changing there. If you are currently taking advantage of something called qualified charitable distributions, QCDs, those are unaffected from IRA. So this would be for people 70 and a half and older that are giving some of their IRA money to charities. That all those rules are the same, and that's still a great tool for retirees. So don't stop doing that if that's part of your plan. Yeah, the good news is that's not changing.
Yeah, that didn't get touched.
So those are the changes. So here's my question to you, Cory. So if you do itemize,
okay,
and you recognize that saying, let's say you make, we'll just use your example. Let's say you make 200 grand a year, and let's say you give $5,000 a year away. Okay. And you're telling me now that I can't deduct 1,000 of it. So I'm only going to be able to deduct 4,000 next year. Should I accelerate my charitable contributions or donations?
Short answer would be yes. I think so.
Into 2020. And again, I'm not taking that as advice.
Yes.
But maybe the question would be, should you consider accelerating?
Yeah, absolutely. Like, because if you are this tax year, 2025, the 1,000 and 2,000, or the AGI floor, I should say, for charitable giving doesn't apply. So, and I think that was really kind of the heart of the question too, that the listener that made this suggestion was, what should we be thinking about this year before these new rules apply? That if you are already well-intentioned in your charitable gifting, that yes, it's definitely something to consider because we don't have to worry about that floor this year.
Right. And especially if you already have a charitable gifting plan.
Yes.
Which I think is a smart thing for people to do. You should incorporate your charitable giving in your financial plan.
Yes.
That way you know. Now, maybe some of you are like me. Like I gift maybe when I'm in the mood, maybe when somebody hits me up.
Yeah.
There are certain things that I'm pretty regular about gifting to, but my plan is, and again, no plan should be this way, but my plan is not set in stone with my charitable giving. However, I've been considering this personally, Cory, because again, I don't want to be subject to this floor. So a great vehicle for people to consider is something called a donor advice fund. Because let's say you give $5,000 a year to your church.
Okay.
And let's say you go and meet with one of our financial planners and they say, yeah, you should accelerate it because you're not going to be able to deduct as much in 2026 and you've got the cash. However, maybe you don't want to give your church $10,000 this year or $20,000, or maybe you don't want to do 4 years worth of gifting in 1 year. Maybe you don't want your people at the church to know how much money you really have, or maybe you just don't feel comfortable giving a charity that much money in 1 year.
Sure.
This is when you would look at a donor advice fund. And these are great accounts to help you organize and plan your charitable gifting. And the way these work is you could put 20 grand in this donor advice fund, and you don't have to give it to the charity the year that you make the grant or the contribution, I guess, to the, and then you can make grants to charities in whatever year you see fit. What's also cool about these donor advice funds, Cory, as you know, you can invest the money, and as long as you donate the money to a charity, a qualified charity, 501c3, the money grows tax-free. So you can actually put money in there, invest it, and give even more away to charities. So I'm really a big fan of donor advice funds for people that know they're going to give. You just have to be careful with these things, though, Cory, because you can't use a donor advice fund to buy a table at an event. Right. Like you can't really get anything in return. Yeah, so you've got to be careful because that's what's actually pausing me a little bit on just jumping into a donor advice fund is a lot of charitable gifting I get something back.
Ah, look at that. So yeah, well, that's true.
Whether it's a golf trip or I buy an auction item, a silent auction or live auction, or a table at an event. Unfortunately, for donor advice funds, they want you to, the code at least says that they want you to donate from the donor advice fund and not receive anything of value back. So these would just be pure gifts. So you got to think about that before funding these things.
Yeah, and one point I want to add around the donor advice fund, really where that can be a useful strategy, is the tax advantages that come with donating appreciated stock. That if you have, we've seen this in years past with clients that have highly appreciated stock where their cost basis is much lower than the current value of the shares. You can gift shares to the donor advice fund. You don't have to pay the capital gains on all the money that you made, and you get to deduct the fair market value of what you contributed.
Big deal.
So yes, I think that for people who are already charitably inclined, if it's already in their financial plan, yes, absolutely. This is something to consider for this year while the deduction rules are still the same.
Right. And maybe you don't have the money this year because it's already November and you haven't planned on this. It's okay to look at a donor advised fund next year.
Sure.
And a strategy we're talking about is called bunching. That's where you put multiple years in this donor advised fund. We're just getting at you might not get the most bang for your buck if you wait. So if you've got the money now and it's sitting idle and you know you're going to give X amount of dollars a year to a charity, my point is you should meet with one of our financial planners and let them model out these donor advised funds.
Yes.
And let's take a look at it. That's really the big takeaway as far as if you're subject to this new floor. So if you've got an AGI floor and you want to make sure you're still getting the max deduction that you can get, that's where you should be looking at these donor advised funds.
Yep, and it allows you to lock in the deduction now, and you can still distribute the funds to charities at a later date.
Yeah, it's good. Let's switch gears a little bit, Cory, and go into pre-retirement versus post-retirement planning.
Okay.
Right? So pre-retirement people, this isn't always the case, but a lot of times they're in higher tax brackets, and so the deductions are worth more. So I've had clients, Cory, that they really maxed out their donor advised fund right before they retired, anticipating that they were going to drop into a lower tax bracket.
Makes sense.
Which is smart. And now what's really cool about these clients is that they've got a large pool of money that when they do want to donate to charity in retirement, they don't have to worry about tapping their retirement funds because they've literally set up an account outside of this. Now, you want to be careful with these donor advised funds, though, because they're irrevocable gifts.
Right.
Once you put money in there, you can't pull it out for personal use. So you don't ever want to overfund these accounts. Like, you can overfund your Roth IRA. You can overfund your IRA. You can overfund your brokerage account.
Yep.
And your kids or your heirs or whoever will get that money. It doesn't work that way. Now, you can set up a beneficiary on a donor advised fund, and I believe your kids or whoever you deem can then run the fund. So this can be a charitable legacy account for your family, but you can't use it for yourself. So the last thing I want to see somebody do is overfund a donor advised fund, and they actually need that money to live off of.
Right.
That would be a problem. And luckily I haven't run across that.
Sure.
And hopefully we never do, but so when you're doing this, don't go do it alone. You need to go look at your financial plan and figure out what makes sense. And then if it's $100,000 you're going to put in there, they can pull that out of your plan to see if your plan still works for all your other goals. So
yes, that's an important
take care of
point.
yourself first. So the key here is if you are working pre-retirement, front load those charitable contributions now while you're in a higher income bracket.
And use, if you can, if you're in the situation, use appreciated securities to do it.
Yeah,
Because
you love that.
You're getting that dual benefit of not paying the capital gains
It's a big deal.
and deducting the value. Makes good sense.
What about post-retirement, Cory? What about clients that are retired? What should they be thinking about?
Yeah, so I think that the QCDs that you touched on earlier, the qualified charitable distributions or donations, I've heard
Distributions.
It is distributions.
I'm pretty sure.
Qualified charitable distributions. That is a great giving vehicle for people that are age 70 and a half or older because the required distributions that come from your pre-tax retirement accounts that start at age 73 or 75, depending on when you were born, this is a way to satisfy some of those distributions.
Yeah.
You don't have to worry about paying income tax, and you can gift the money directly to a charity. So it is a really powerful way. I have a lot of clients, Jake, and I'm sure the same is probably true for you, in that they are largely planning on using their required distributions or their qualified charitable donations as a major gifting vehicle once they reach age 70 and a half. Because prior to that, you can't make a gift to a charity from your IRA. But once you're at age 70 and a half, you can.
Right. That's really good. And then, the other piece here is if you don't itemize, a lot of retirees don't itemize, because they typically don't have, some of them have mortgages and that's okay. But just know these universal deductions start in 2026. So make sure that you're taking advantage of that in 2026 if you don't itemize. Right?
Yep.
So that's a key one.
Yeah, you don't have to itemize for those QCDs, which is a huge benefit to it also.
Right. So let's get into our action steps.
Okay.
So again, basically you want to review your charitable goals now. Don't wait till December 31st and call our office and say you want to open a donor advised fund.
Right. It's not going to work.
This thing takes time to open. It might take a week or two to get the account opened, to get it fully funded. There's a lot that's involved with it because this is an irrevocable gift. It's a different type of an account. It's not like walking into your local bank and just saying, hey, I want to open an account today.
Right.
So give yourself some time. Don't wait till the end of the year. Talk to your CPA about it. CPAs, I don't think, Cory, should be that busy yet, right? So don't let them.
Yeah, the time is coming, but not yet.
Not yet. So hit up your CPA now and say, hey, I know the charitable rules are changing next year. What do you think about me accelerating some of my contributions or donations. And again, talk to us because we do the planning piece of it. But hit up your CPA now also. And just at least talk about those donor advice funds. Again, we've been doing donor advice funds for many years at Falcon Wealth Advisors, Cory. So our team is very familiar with them. And it's easy for us to set up. But again, it does take time. So give yourself some time to make that happen. Don't hit us up at the end of the year. It's not going to be possible, more than likely.
But the reason, just to stress what you were talking about, Jake, and bring it more down to a human level too, like what we're talking about here is how far your generosity goes. So for people that are charitably inclined, that are well-intentioned in that regard, that's the reason for doing this planning now.
Right.
How far can your generosity go?
Yeah, and like Cory mentioned, don't sleep on those appreciated stocks. So if you've got a stock that's up, don't sell it and then give that money to a charity.
Correct.
Instead, try to give the stock either directly to the charity or into a donor advice fund. It's a big deal. If you can avoid those capital gains taxes, why wouldn't you look at that?
Exactly. Dual benefit.
Yeah. So that's good. So thank you so much for our loyal listener who brought up the topic. I got a soapbox to go over today, Cory, but is there anything else that we missed, Cory, that you wanted to touch on?
No, I think that, charitable giving is obviously there's a tax move, right? That's involved there. But I also think that for all of us, it is a reflection of what we value. So I think that, using the opportunity, the window of opportunity where we're at, in 2025 to take advantage of this, and whether or not you bunch your charitable contributions into a donor advised fund this year, even if you're not going to do that, it still makes sense to have charitable planning and charitable gifting. If that's part of your financial plan, have it mapped out and have a plan for it.
Yeah, that's good. And if you want more information on this, simply email Luke at falconwealthadvisors.com, and Luke can get you access to a white paper that we have available to us that'll kind of go into this a little bit more detail. So again, Cory and I want to hit high level. This show is not advice. Meet with your financial planner, meet with your tax advisor, and go over all of these things. And a quick commercial before I go into my soapbox, Cory.
I'm ready for it.
Thank you again to all of our subscribers. Our subscriber count continues to grow. So please thumbs up, like, share our content. The whole point of Upticks is to enhance financial literacy. If you know anyone that can benefit from our services also or benefit from the show, share it with them as well. And if you want more content from myself or Cory, we're both out there and we're active on Instagram. My Instagram handle is Jake_Falcon_CRPC. And Cory's is simply Cory Bittner KC. Also, I've got a best-selling book out there, Cory, called Retiring Right, Smart Steps for Exiting Corporate America. You can also email Luke at falconwealthadvisors.com, and he can get you access to your free ebook. So basically a digital copy for free, or it's out there and available on Amazon if you want the physical copy that's available for purchase, right?
That's right. And if you follow us on Instagram, that's where Jake and I can go on our daily soapboxes. But since we're recording this here, Jake, let's hear what you've got.
I think you go on your soapbox a little bit more than me, Cory, on there. But hey,
that's an opinion.
For each its own. Here's what I've been talking about lately, and it bothers me still. I posted about it yesterday, actually.
Okay.
Well, not about this specifically, but real estate investing.
Mm-hmm.
I am not, and again, this show's not advice, Cory. I am not a fan, though, of people going out there and dabbling in rental properties before really understanding what ROI is and knowing what they're getting themselves into.
Okay.
So ROI stands for return on investment. And this is what I posted about yesterday. So if you bought a property, Cory, for $1 million, right? And then you sold it for $1.5 million. The ROI formula states that you take the difference. So this would be $500,000. And you divide it by your purchase price, which would be $1 million.
I just made 50%.
And you multiply it by 100, and there you go. You get 50%. And this is the big mistake a lot of individual real estate investors make, Cory, is that let's say you owned that house for 3 years before you sold it. So you're still like, Jake, I made 50% in 3 years. You're not doing that for me with stocks, right?
Yeah.
Say, okay, fair. But the problem that people have is they don't look at their net profit. That $500,000 profit that we just talked about, Cory, is their gross profit. To calculate your net profit, you have to subtract property taxes that you paid on this property every year. Maybe those are $10,000, $15,000 a year. I don't know. Higher or lower, depending on where it is. Insurance, home insurance, right?
Which keeps getting more expensive.
Right.
It's a big one.
Yes. Anything associated with upkeep of the home. So mowing the yard, the utility bills. If you had to fix something, plumbing, electric, right? The roof, all of any agent broker fees from buying and selling the house, right? You've got to subtract all of these things out to get your true net profit.
So I didn't really make 50%.
You didn't make 50%.
Yeah.
You know, and that might be, depending on what you did, you might have spent, once you add it all up, hundreds of thousands of dollars.
That's true.
So then your net profit isn't 50%.
Right.
And then you have to annualize that, right? So if again, we're talking over 3 years, let's say you say, well, I still made 20%. Well, when you back that out, that's probably like only making like 5 or 6% a year. So how good really is that?
Yeah, that's good.
Plus all of the time and the distractions. I always joke, like the reason I'm not a landlord is I don't want to unclog toilets at midnight. I don't want to do that. I don't want to get that call.
Yep.
I don't want to get that call from somebody else. And to speak of, if you're renting it out, you've got to worry about tenants trashing your place. Or what if they skipped a month in rent? And all of these other things. Now, again, I guess you would technically want to count rent in if you are renting it out, right?
Yep.
So again, that needs to be included in the profit. But even that's taxable. So you got to back out taxes on those things. So my point is, you have all these people on the internet touting how to get rich in real estate. And you just got to be careful. Like you can't, it's not as simple as it sounds. You've got to almost, like I think the best people, generally speaking, to be in real estate are people that have time to manage the property themselves, are people that are very handy, can fix a lot of things that go wrong with homes themselves, are somewhat thrifty, right? They know how to find a deal. If they need a new refrigerator, they know where to go and get one of those. I don't know. I go to a high-end appliance shop. You know, I'm not, you know, because I want my wife to have a nice
Furniture Mart.
I don't want to go there. Even.
Well, wherever. I know.
Anyways, so thrifty. And then also, they've got to understand or have a network of people that they can rent to. Because if you don't have a solid network of people to rent to, and where you can get market rate rent, like I'm not talking about renting it to your kid,
right?
At a steep, like renting to your Daisy for $200 a month,
right?
When you should be renting it for $2,000 a month,
right?
I'm saying you need to have a solid network of renters, or if you're doing a Airbnb, that you've got a way to market it yourself.
Sure.
Because even Airbnb, they probably take a big fee out of.
Of course, absolutely, yeah. They're not doing it for free,
right? So you've got to deduct that. So again, I get it. There's a lot of wealthy people in real estate. There's a lot of ways to make money, not just the stock market. I just feel like I don't understand why people don't get, like, why don't you buy a diversified basket of stocks and not have to go through the headache of all the other. Yes, that's not free. You typically are paying an advisor. Sure. If you sell the stock, you got to pay capital gains and you know those certain things. But like, why, Cory, do you think people don't see that? Maybe I don't know. I have a thought, but why don't more people see it that way? I feel like there's just as many people that want to do real estate as that want to do stocks. And I'm curious why the real estate people don't understand that it's not as easy as it sounds.
Well, I think personally, I think a huge part of it is what the real estate market has done in the last 10 years. Like if the whole conversation around this would have been different in 2010 after the housing crisis.
Good point.
So part of it is just the environment that we've been in. Real estate prices have just continued to climb. So I think that naturally, but you know, interestingly, stock prices generally have done the same thing.
Yeah.
But I think that really to your point, I know people that have done really well for themselves investing in real estate, but it's almost exclusively what they do.
Right.
And I know people that have done really well investing in equities, in the markets, and that's almost exclusively what they do. I think where it actually gets dangerous is when people who have accumulated their wealth investing in the markets decide that they want to get into real estate.
Right.
And it's also the reason that a lot of real estate investors say, I don't want to touch the stock market.
Good point.
Because it's not a market that they know, that they understand, they just see it a different way. And I'm not making the argument that either way is right or wrong. Like I think that you can build wealth however you choose.
Sure.
But I think that that's where it gets dangerous, is when people who have made all of their money in the markets, or they've made all of their money through employment, right? People saving money in their retirement accounts, deciding, you know what, I'm going to get into real estate now. Like that's where you need to be really, really careful.
Good point. Or maybe they haven't even invested. Maybe they're just high earners.
Sure.
Right? Maybe they make a lot of money and then there's a problem with overconfidence. So like, well, I'm successful. Let's say they just work at a corporation.
Totally.
And they're a senior vice president there and they oversee 1,000 employees. You know, they're like, well, I'm good at my job. I can be good at real estate too.
Sure.
That doesn't always translate. Now, I have clients that have done that. I have clients that have had corporate jobs and are successful at real estate, but they're not doing it casually.
Right.
They're intelligent. They work hard at it. They're smart about it. They've crunched the numbers forwards and backwards in every which way. And then they still hire us to build a plan around that real estate portfolio.
Yep.
And that I can see being successful. You're right. I think it's the casual person who doesn't understand ROI. That's what really bothers me.
Yeah. Yeah. I mean, to again, bring this to a personal level, my wife and I bought our house and it's our primary residence, but we bought it in 2020.
But it's not an investment. That's my other problem.
No, and I agree with that. But my point is, so we bought the house. And it's easy to go, and now, nowadays you can just look on Zillow or whatever app you want to see, and you get some made up price for what your house is supposed to be worth. But my point is, like, my wife and I have a shared document on our phones where we keep track of expenses that money that we've spent on our house, and it's a never ending growing list,
Right.
because that's part of home ownership. But the point is, it's easy to say, well, I bought it for this, the house appreciated, I can sell it for this, I made this amount of money. It's like, well, not really,
Right.
because I'm keeping track of it. I know what the cost is, and again,
have you made that much money then?
Not really.
Right. And your house is probably appreciated pretty well.
Yeah, we bought it at a great time. It's definitely appreciated, but we've put a lot of money into it. And because, again, we've wanted to make it our home. Like, I'm not doing it as a primary investment.
That's my other problem, that a lot of these real estate agents tell people that their home is an investment. To me, an investment should be an unemotional. Now, money is emotional, so I don't want to diminish that. But, like, if we have a stock that is doubled in value overnight, we're not going to, I'm not going to speak for our portfolio manager, but more than likely, there's probably a high likelihood that we're going to sell it or sell some of it.
Right.
I'm not doing that with my home.
Right.
And my home doubled in value overnight. I wouldn't sell it, believe it or not, Cory. I wouldn't.
Right. Because you just feel a little bit better about it, I guess.
I don't even think, that would even,
that.
no, because it's not an investment for me.
Yeah.
It's a home for me and Rachel and Einstein.
Yeah.
Right. And we moved there very intentionally. We didn't move there to make money. We moved there because we wanted a home that would check all the boxes of a place that we want to live.
Sure.
And that was it. I had nothing. Now, we wanted to get it at a good price.
Of course.
But when we bought it, actually the price wasn't as important to us as long as we felt that we were paying a fair price. Whereas with investments, you're typically looking to buy low and sell high.
Right.
And again, if somebody came in to knocked on my door, or wrote me a letter, because these people write letters, right?
Right. Yep.
Saying they would buy my house for whatever Zillow says, or $1 million more than Zillow says, whatever, I wouldn't do it. And that's why I don't think homes are investments. Homes are where you feel safe and are warm, right? And make memories and raise a family.
Yep.
That's not an investment. I'm not raising a family in my stock portfolio.
True.
Right?
That's a great point.
So, and homes should be full of emotion.
Right, they are.
Your home should be full of emotion, a lot of emotion. And I'm not saying money shouldn't be emotional, but my point is, like, if a place is supposed to be full of emotion, that's even less of a reason to have it as an investment. Yep. Home is not an investment. You're not going to convince me that it is.
Right.
It's an asset.
Also a liability.
It is a liability.
Right? I mean, it sits on both sides of the balance sheet.
Right. It does. But yeah, so I think that's where people get confused. They think an asset is an investment, and it's not. My car's an asset. It's not an investment.
Right.
True. My car is an asset. It's not my wife's wedding ring is an asset. The art we buy are assets.
Sure.
I would even call the art investments, believe it or not. And some people would argue against me on that.
Sure.
I still don't know if we would sell our art. Like, I was talking to Rachel about that the other day. I was like, when would we ever sell? Like, so is this an investment? It's not.
Mm-hmm.
Unless I guess unless we moved, like, we have a nice piece of art in our office that wouldn't fit in our new home. I would sell that right now. But you know what? I think the team likes it.
Sure.
So I might not. But again, I you know what? I'd be lucky to get what I bought. So is that a good investment? No. But I didn't buy it. But that's not why I bought it.
Yeah. Yeah. And I
Same thing with my house. Like, when I go to sell my house, if and whenever that is, I'm probably not going to care how much money I make on it because I didn't buy it as an investment.
Yep.
I don't care. Like, my other one, I made a little bit more than I paid for it. And I bet I lost money on it if you add up the money, if we add up all the taxes and blah, 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 right? So but I didn't care about that.
Yeah.
It's a home, not an investment. If my house, if I looked at it as an investment, I would have sold it differently.
Then you'd probably treat it differently too.
I would have treated it differently.
Yeah.
I wouldn't have let Rachel put a nail in the wall.
Right.
You know what
That's
I
going to
mean?
hurt our ROI.
Yeah, you can't.
Yeah.
Don't hang anything on these walls. These walls need to be perfect.
Yeah, that's true. Well,
You
and
know what I mean? So
one other
I don't
quick
know.
point just to make here, because we're talking about this, I think that liquidity is also crucial.
good point.
You know, at the end of the day, your home, any real piece of real estate is really worth what someone else is willing to pay
for it. Yeah.
which is a lot different than money that's invested in the markets. Like there is a big advantage that comes with having liquid investments,
Right.
From being able to convert your investment into cash quickly. And I think with real estate, that's not always as simple as people think it's going to be.
Yeah, the markets have that. It's called a market maker, and they make a market for liquidity, and that's what keeps the markets from being so volatile.
Yep.
Yeah, and functioning. It's you don't have a market maker in the real estate business. You don't.
Right.
There's no market maker. There might be these big institutions that'll gobble things up, but they're not market makers.
Right. And they're certainly not looking to pay a premium.
No, not at all. So, all right. Thank you, Cory. I feel a little better. Got on my soapbox. So again, real estate can be, and I'm not talking about your home. Like you said, you can make money real estate investing. My point is, I want to caution people to do your homework, understand ROI.
Yeah.
Before you get into it, and understand all the work and the time and the money it's going to take. And it might not be as nice as a picture or an idea once you start crunching the numbers. That's what I'm getting at. That's all I'm getting at.
Good. Nice soapbox.
All right, Cory, you got anything else as we wrap up today's show?
I don't think so.
Well, thank you as always for joining me. Thank you all for tuning in. Also, quick plug, if you know anyone who wants to be on Upticks, we're going to roll this out in 2026. Then we're going to start having guests on our show.
Come sit right here.
So if you want to be a guest,
Right there.
or you know someone that could be a guest, email Luke@FalconWealthAdvisors.com and we'll start compiling our list of guests for 2026. With that, thank you again, Cory. Thank you all for tuning in. We hope you have a great week.